yes, the Treasury, the Fed, they have a problem. How can they solve this problem? Well, there's the usual tool that they have. It's called money printing, or QE, or they could also use yield curve control, which is kind of a QE. Yield curve control, what the Treasury will do is say that, and the Fed, that if the 10-year yield or gets to 5%, they'll start buying, so they'll cap it there. If the 30-year gets up to 5.5%, they'll cap it there. And how do they cap it? Well, by buying, going to market, printing reserves or money, and buying the bonds. Wednesday, April 16th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, it's getting very serious for the U.S. Treasury and Uncle Sam in terms of their refinancing for 2025. That's the fiscal 2025. And I think there is a rollover risk, and we're going to look at what that is. But be as it may, investors seem to be rushing to the ultimate safe haven. Yes, gold, as I speak here at 8:15 a.m. London time, is approaching 3,300. Yes, in the spot price. The high has been 32.98. It's up 2%. And before I go further, just wanted to emphasize that I think, yes, it's more important than ever to keep hold of your physical gold and silver. I got a message from someone yesterday saying, I have X amount of fiat in the bank. Is it still good to buy gold? And I said, well, yes, of course. The risk, in my opinion, is to have dollars, pounds, euros, Swiss francs, all the fiat currencies. And gold is not just approaching a new all-time high or making new all-time highs in dollars, but also in the other major currencies. It's a fiat currency problem. It's a debt problem. So rollover risk, what is that? Well, there's a very good movie or film from 1981, and maybe it was predictive programming. It's not the best of movies in terms of the acting, but it's a good movie if you are into the markets, into finance, into the dollar. And back then, back in this rollover movie, the problem was Saudi Arabia, not China. Saudi Arabia, through a hidden account with a bank in New York, was buying a lot of gold, physical gold. And there came a point where these banks, they couldn't roll over their loans with the Saudis because the Saudis rushed for gold. The dollar collapsed. Everything collapsed. It's what's happening today, in my opinion. And we've seen lately that the Chinese have been buying a lot of gold as well. Of course, there is this tariff war going on with the Chinese. And would you keep financing the country that's trying to, waging trade, monetary war against you? Probably not. Would other countries that hold a lot of treasuries be keen to keep holding it and keep buying it? Maybe some of the allies, some of the poodles in Europe, but not the countries that are moving towards BRICS. I even heard that Vietnam wants to join the BRICS. So rollover risk basically is when big borrower, i.e. the U.S. government, like in 1981, and the big banks as well, because the big banks are now, there's now talk as well that the U.S. Treasury wants to take over more of the regulatory narrative or the regulatory power vis-a-vis the banks, and they want them to allow to hold a lot more treasuries. Why do you think that is? it's called the statutory leverage ratio. They want to allow, JP Morgan and all the other big Wall Street banks to hold a lot of treasuries and buy a lot of treasuries. Well, because foreigners their appetite for treasury is going down massively. It's called de-dollarization. Is it any wonder that I heard yesterday as well, there's news about Jamie Dimon, the CEO of JP Morgan. He's been selling a lot of stock. He sold another 32 million yesterday. Well, he can see the writing on the wall, in my opinion. And the other thing that's happening, and it's going to hurt the economy, even though I think President Trump administration official said there's 100% chance of that. 100% we're not going to have a recession. I think he's kind of deluded, whoever this person was. Well, we see here that the 30-year mortgage rate just hit 7.5%, the highest since January. That's not going to help. Buying or refinancing a home has gotten even harder. So we've known, of course, that, for the last 6 months, 12 months, that the U.S. Treasury has $7 trillion to roll over, and also to basically there's new debt coming through as well because it's running a deficit. So I think the total refinance is about 6 or 7, and then 2 trillion of new debt. And one thing that I was looking at yesterday, and I think is very worrying, is long-term Treasury yields. Yes, it's kind of stabilized for now, but it has risen quite a bit in the last couple of weeks or so. We saw the 10-year yield got back down to like 385. And as I speak here, we're now at 430. Yes, it's down a little bit overnight. But I was also looking at the long-term T-bond, or the 30-year bond future. That used to be like the benchmark. And a lot of people still look at it. And if you look at this long-term chart here, it's a monthly chart. You can see how we broke this upward trend that we've had since 1981. Well, that was the era of financialization, rising bond prices, decreasing bond yields, made it very easy. It was like sailing with the wind. You could always refinance at lower rates. Asset prices, which are based on the risk-free rate of treasuries, they kept being discounted higher. But now everything's reversing, and this chart it looks very ominous in my opinion. As most of you know, I worked in the bond market for over 20 years. I used fundamental analysis and technical analysis to advise my institutional clients about what I thought was going on. And if I was managing a big bond fund right now, I would try to get out of 30-year bonds as much as possible. And why is that? Well, because we've broken this upward trend, which means, and this is a 40-year trend that's been broken. And I've been warning about this change in trend since late 2019, late 2020, mainly because cycles don't last forever, of course. And what this will mean is that it will be much harder to borrow. Asset prices are not going to be as elevated. The big everything bubble is going to deflate, and that's what we're seeing the beginnings of. And it's going to be a very long-term trend. And this chart to me here, if I look at that, there was a blow-off top, which is really interesting. Just before, that's the blow-off top there to up almost 200, and I think that happened during COVID. and then we've seen a massive drop. Basically, the T-bond future went from 200 almost to 100, and it's been consolidating here. But what we call that in technical analysis, in the business, in the markets, is kind of a bear flag. So you get the big move lower from 200 to, let's say, 105, and then you get the consolidation, and it usually goes up. It goes counter to the big move down, and it depends. It can take a long time. I mean, this is a monthly chart, so it could be over a year or two, this consolidation. But eventually we break the bottom of the first move down, and then we go down as much as we went down in the first leg down, which doesn't really bode very well for the price of long-term bonds. I could see the T-bond future going back down to testing like the 60 level from the early 80s. And I think long-term yields were double digit back then. I'm not saying it's going to happen this year, but it could happen over the next 2 to 3 years. And I think that's why the U.S. Treasury is desperate to take over the regulatory regime of the banks. It's desperate to tell banks, pension funds, and other financial institutions, they're telling them, yeah, buy as much treasuries as you want. It's not a risk. But I think it's very serious. And yeah, I think Jamie Dimon thinks the same. There's an article here I found as well. The Fed can't save this one. Why bonds may break the stock market in 2025. This is by Knox Ridley, portfolio manager. And I think he's saying the same thing because there's so much bonds out there to be refinanced. Why bonds matter. The trade war is taking center stage, and for good reason. Liberation Day shocked the markets in the scope and severity of tariffs imposed on foreign nations, leading to one of the most extreme 3-day drops in market history. The tariffs and what this will mean for earnings and domestic growth is causing a level of uncertainty rarely seen in public markets. While the masses are focused on the potential resolution, what will happen if we do not see one? There is a more immediate problem. No one is buying government bonds despite growth slowing down in the economy. This is not normal behavior and will become a problem if not resolved. Yields are too high for new bonds being issued, whereas the U.S. government needs lower yields to financing the breathtaking amount of debt coming due this year. And I also noticed that, let's see here. Where is the story? Oh, yeah. This is an article from February, earlier this year in February, and it says, Bessent's Treasury sticks with Yellen-era long-term debt plan. There's been a lot of criticism, and rightfully so, of Janet Yellen issuing loads of long-term debt, trying to keep the debt off the short-term part of the curve. But Bessent is doing the same thing. It says here, new Treasury chief had criticized predecessor strategy. U.S. sees current auction sizes for at least several quarters. So U.S. Treasury on Wednesday maintained its guidance on keeping sales of long-term debt unchanged well into 2025. So why is this a problem? Well, because I expect long-term yields to go a lot higher, the 10-year, the 30-year, and the Fed might cut the Fed funds target. All that will do is it will steepen the yield curve. So, yes, the Treasury, the Fed, they have a problem. How can they solve this problem? Well, there's the usual tool that they have. It's called money printing or QE, or they could also use yield curve control, which is kind of a QE. Yield curve control, what the Treasury will do is say that, and the Fed, that if the 10-year yield or gets to 5%, they'll start buying, so they'll cap it there. If the 30-year gets up to 5.5%, they'll cap it there. And how do they cap it? Well, by buying, going to market, printing reserves or money, and buying the bonds. So that's yield curve control. But that might not work, and then they'll have to just go all in with QE, and it will dwarf the amount of QE, in my opinion, that they did in 2020 and 2021. And what will happen to gold and silver and real assets? Well, look at the moon, in my opinion. That will mean the dollar going down. So, yeah. It's now 8:32 a.m. London time. Yeah, the high in gold is still 32.98. Right now we're at 32.95, up 65 bucks. Silver, I noticed earlier today when I was walking with Rudy, and there's a pretty cold wind today, an ill wind. And I think that's what bonds are telling us. And also gold, it's an ill wind for the economy and for the public, for everyone that depends on this fiat currency system. Of course, I think if you've got gold and silver, you're going to be sheltered from this wind. Anyway, silver is caught up, actually. We're now up 52 cents at 32.85, still underperforming gold a little bit. It's up 1.6%. The stock market indices are down this morning. The Dow is down 300 points, 0.75%. The NASDAQ 100 is down 400 or 2%. S&P is down 72 or 1.3%. Even though the euro and the pound are up strongly versus the dollar, gold is up even more strongly against the currency. So that's how it's going to be, in my opinion. We're approaching all-time highs in gold and the other currencies as well. We've got crude oil down 0.75% at 60.38, and we got high-grade copper also up, down 1.28. And I suspect the reason why silver earlier on was not doing that well is because people still associate silver with base or industrial metals, but I think it's we're near a juncture where people are going to associate silver to as a monetary metal and as a kind of a mini safe haven compared to gold. And I think silver will actually take off and also outperform gold. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.